Holy F. This is very scary. Bonds have pivoted and they're going straight up with a golden cross. And when bonds go up, that's normally very bad for stocks. So Jerome Powell's going to speak on Wednesday this week, and what he says will really matter. It will move the market. And there's something that's worse than a recession. It's called stagflation. Stagflation is considered to be worse than a recession because it is more difficult to remedy. Oh, no, that doesn't sound good. More difficult than a recession. Everyone's talking about hard landing, no landing. Well, what if we get stagflation? And at least as of this week, on Thursday and Friday, we got GDP and inflation numbers, which show us that we have higher inflation than growth. That's what stagflation is. Oh, no. So when Jerome Powell speaks this week, I think that's what could really matter. The Magnificent Seven will report with Apple and Amazon. But why does this one matter? Well, why is stagflation the worst? It's harder to address than a recession. Oh, great. Let's read the next one. What happens after stagflation? Well, if companies lose enough money and go bankrupt, investors can lose significantly. Oh, cool, right? We're investors. Cool. How long did stagflation last? Only 9 years. That's not that bad, is it? Only 9 years? Yeah, that's not terrible. And stagflation trade gains after hot inflation prints. Uh-oh, right? So the question is, it's also not unusual for us to have weakness during this time, meaning strong start to an election year and showing some weakness into the summer. So is the correction here? Is it over? Are we going to have a dip, a correction, a mild correction, a normal correction? Hey, we normally get 7 dips per year, 3 mild corrections, one straight up 10% correction. So I think that's what the question is. Are we going to go lower and then lower, or are we going to go lower and then higher, which basically means the correction's kind of over. We go a little bit lower, maybe 5, maybe up to 10%. Then we reverse higher. All right. Well, again, I'm saying this is very scary. As I'm looking to other monthly charts that the bulls should be mindful of, I'm showing you here that the dollar shows a massive bullish cup and handle and pointing up as well. We just talked about the 10-year note, which has a golden cross in the making and pivoting off of that 1990 area. And then finally, QQQ, which currently has a breakdown. We're below the previous candle low. And that's not good for stocks, right? They're pointing down as much as people might not want to say it. So it's either doom or gloom, right? Yeah, great. Yes, I would love to be telling you a different story, but the fact of the matter is we're getting evidence here. Doom and gloom is great because if we're prepared for what could happen, if it does happen, it means that we're better prepared. We have a plan the work the plan. All right, just before we go further, and I got a lot of other great stuff to do for you, I'm just going to ask you for a huge favor. If you could please consider smashing that thumbs up or subscribing to the channel, that would be greatly appreciated. So what I'm really talking about is just that it really matters what Jerome Powell has to say on Wednesday. I want to listen to what he has to say. Instead of telling him, hey, here's how we're going to trade it, let's just hear the man talk. But in terms of where we are, grab your chips because we got some dip. But we're starting to see evidence that the bulls are attempting a few things. We're seeing hollow candles. We've started to stop going down. Hey, it's been 1 day, right? We're not really stopping to go down with 1 day, but we're attempting to run a test to the 50 DMA, which is exactly what the bulls need. Yes, we need to get over that short-term price. And we're going to make it even simpler for you because this is the dip recipe. It's not the reversal recipe. Our platform looks for reversals, thealgo.com. And to make it very easy, we're either going to hit the targets, which is exactly what the bulls want, run a test over that 50 DMA, or the bears are going to print a monthly lower low and they win. That's it. It's either the targets or the stops. Like, how much simpler can we make it? I wish I could make 1-minute videos every day, but there's always context. There's always news. And this week's no different. So let's go in and investigate what is likely going to be on the docket this week as Jerome Powell is set to speak. Well, stagflation trade is roaring back in S&P's month of pain. Cool, right? It's not me saying that. It's just been a month of pain. Stagflation we've talked about. It means persistent high inflation combined with high unemployment and stagnant demand in the country's economy. While we don't have unemployment yet, we have high inflation and we're starting to see stagnant growth. So this is a narrative that is not quite there, but we're getting evidence. I don't want to ignore it. I want to be very receptive to it. Inflation is currently higher than growth. That's not good. And the US is the only game in town, which means the world, which is strong. Everyone else is weakening. In terms of the FOMC meeting calendar, there's these meetings with little asterisks. These are important meetings because they're a meeting associated with an SEP or summary of economic projections. When the Fed meets on May 1st and Jerome Powell speaks, we're not going to get an SEP. So what he says will matter. What Jerome Powell has to say is going to move the market. There's not going to be very much in terms of a rate decision. There's not going to be anything happening. What Jerome Powell has to say in the US is very important because what a Fed rate cut delay means for the US and the world is that as US companies are exporting, their earnings take a hit. And borrowing costs for the rest of the world are high, which means it's bad. And the bulls and bears are still very divided. FundStrat's Tom Lee predicts the S&P could go to 5,700, maybe even higher. Cool. But over here, we have an elite forecaster saying the S&P is at risk of crashing 44%. Selling early could pay off. Well, as I showed you, QQQ printed a monthly lower low. So there's early evidence that we're starting to see that. S&P printed a monthly lower low too. And the stagflation trade is gaining steam after hot inflation prints. So if it continues, the trend is likely going to continue, the stagflation trade. So tell me more about this because I don't quite understand. All right, well, we talked about US yields as well. That's what I showed you here at the very beginning. The thing that's very scary, yes. US yields soar as traders see the Fed delaying first cut to December. All right, here's a graph of you showing it, going back to April to now, right? The Fed's forecast. Okay, so what does this mean? Because I'm still confused. Well, remember, we don't actually want the Fed to cut. We don't want them to pivot because when they pivot, it usually means something is broken, right? They cut rates, boom, we go down. What does that mean, go down? Man, hard landing. We go down by 36, 48, 27, 51, 58, and 35% after the Fed cuts. The only time we avoided that was right here going into the 1990s where it didn't do it. So it like really matters because, man, that's a big cut. That's more than a recession. That's the tech bubble boom and bust, and that's the great housing bubble, right? The Great Recession is what they call that. So if this is worse than a recession, I think it really matters whether it's currently 1995 or just another market cycle. This stuff might confuse you, but what it basically means is that the longer that we hold the pause, it's usually a deeper recession. We go back to the 2000s. We can see the size of the recession, which is going to be the gray line here. Longer pause, 6 months, not so bad, right? It's not terrible. If we look to the 2008 one, well, they paused for 13 months. Yeah, that one was bad, right? That's the Great Recession. Oh crap! And we're currently on pause for 8 months. Okay, so right, that would we've currently been 8 months for the last one. So I'm not sure what's going to happen, but it's on average 9 months to the first cut. So is the Fed going to cut because they can or because they need to? 1995 was the only time they cut because they were able to. So now let's talk about the stagflation a little bit more. Persistent high inflation combined with high unemployment and stagnant demand in a country's economy. Well, there's only a few pieces of the puzzle, right? We talked about the inflation versus the GDP. It's starting to look bad. If we look at some graphs, because, hey, we're here for stocks today, let's look at some lines, let's look at some graphs. Well, here we see that when Jerome Powell says that we're not seeing continued, what's the word? Continued progress. Well, it just means that we're seeing high, lower, high, lower, high, lower, high, lower, high, lower, high, lower, high, double top. Okay, lower, high, double top. Okay, well, we're not really, it's not moving lower. The last four candles are stuck versus the trend from before. Yes, that's inflation. It appears persistent. Again, that's what we're looking for here, that definition of stagflation. Persistent high inflation, right? Transitory. It's the reverse of transitory. It's persistent. But then we also have to see stagnant demand and high unemployment. So this just shows you that we're seeing one part of the puzzle here, right? The inflation, the persistent inflation. Well, here looking at GDP, well, okay, high, lower, high, lower, high. Oh, crap. So this one's not looking good either. 1.59 is worse than the previous numbers before too, right? 2.6, 2.5, 2.2, 2.0. This is government spending here. Yep. So it looks like the trend is about 2 when it's high, lower, high, lower, high, lower, high, lower, high. If we remove these two right here, right? Government spends going into an election year. Yep. So that's what I'm looking at. It doesn't look good. And the Fed will not provide another SEP until June. So what did they say last time? Because I want to hear what Jerome Powell has to say. He could be coming out pretty bearish, or could be coming out medium. Why? Because they don't have to provide another one of these. This right here is what matters for me. What we look at is GDP, inflation, and the Fed funds rate. Specifically, what I'm pointing to here is the Fed funds at 4.6. And we'll talk more about this stuff later during the week. So just subscribe to the channel or smash a thumbs up. And I'll make sure to walk you through this on Wednesday when Jerome talks. But to make this really simple, they told us that they were expecting higher inflation and higher growth in the last SCP. They have all these numbers here, but basically that means that they also did not change the Fed funds rate to 4.6 by the end of the year. Well, right now we're at 5.3. So Jerome Powell will have to come out hawkish to show that actually that 4.6, which we forecasted in December, which is when the market went up, is maybe a little bit too high. Maybe we're only going to be at 5, right? That would be one cut, which is what the market's pricing in right now. Okay, and this is what I want to hear Jerome Powell talk about. Rents are the Fed's biggest stumbling block in taming U.S. inflation. Yes, that's what I want to hear him talk about. Does he have anything to talk about? And then the other important dates for this week. But other than the U.S., we do have CPI coming in out of Europe, which is down to 2.4. So inflation appears like it's a U.S. story. And I think that's really important. We get average hourly earnings on Friday as well. All right. So is it a dip? Is it a mild correction? Is it a straight up correction at 10%? Is it a severe correction or a bear market? Tell me in the comment section, because if we look back over history, stocks are likely red in April, ending the 5-month win streak. And normally after 1 month, it's flat. On average, we go nowhere, 0.00 or 0.1. After 3, 6, 12 months, we avoid it. It appears like it could be 1995 if this plays out. JP Morgan is a little bit worried about a further sell-off as well. The current market narrative and patterns are increasingly resembling those of last summer. What did we just show you? Last summer. Well, we're already being told if it's like last summer and now we're looking like the summer, man, it might be time to just be mindful of that. This appears very scary. Do not be scared, though. There are buyable dips. We have to just make sure that the lines are going up that we're buying. If QQQ is pointing down, that's not good. We want to see QQQ pointing up. So when we see a candle like this, we just need more evidence. We need to see more lines, more candles. Extreme fear is for buying, but we're not there yet. Extreme greed to extreme fear. Extreme greed, we're not into extreme fear yet. We're close, but no cigar quite yet. All right, that's it for today's video. Subscribe on the right-hand side or watch the video on the left. I'll see you on the next one. Thanks so much.